In our last episode of Wealth Talks, we answered questions that appear on Reddit about the infinite banking concept.
There's a lot more questions where those came from, so today we're going to go to Reddit's questions on infinite banking again and answer more questions.
And I have them pulled up here. This first question was asked less than a month ago. And it says, just a thought. I've been seeing this YREFI commercial and checked out their site. You can invest a minimum of $50,000 for 5 years at 10.25%. If I get 3% interest guarantee on my cash value and have a fixed 4% loan interest with my policy, wouldn't it make sense to invest $50,000 with YREFI, then just pay the policy interest until it matures? I just don't know if taxes will make it worth it, but it seems like it may be worthwhile. What do you all think? They have a simulator on their website to calculate returns.
Boy, there's a couple of questions in that question. Number one, there's a misunderstanding in that his whole life insurance policy is going to give him a 3% return. Whole life insurance policies do not have a guaranteed rate of return. They have a guaranteed value of cash value that will appear based on the premiums that are paid. The second thing is can you take a loan from a policy and not pay it off immediately, but pay it off 5 years after your investment? Yes, that's easily done, but you need to figure out and calculate what the interest is going to charge you on the loan to see if it's going to be beneficial to make that loan.
So the answer to his question here is a potential yes. He could take the money and earn with this investment that he has found, only paying the interest until that investment matures, then paying back the loan. That is possible. Would it be profitable or not? You would have to do the math and figure that out.
One of the things that could make it profitable or not is how mature is his policy? Is it a brand new policy, or is it a policy that's been around for 15, 20 years that is earning a much higher annual return on premiums than a new policy where you're actually losing cash value? You don't have as much cash value as what you paid in premium for 4 or 5 years.
Right, the capitalization period. So it's not accurate to say if I get interest guaranteed at 3% on your policy, you'll never get a guaranteed interest rate on your policy, on your whole life policy. It just doesn't happen. But what you can do is look at your cash value and figure out how much it's increasing over the premiums you paid. You can know that from a get-go on a policy. Just look at the guaranteed values on the illustration. The policy has to at least be that. And you can figure out what your internal rate of return is, what it's called, is over time or in a specific year. But that internal rate of return is going to be very low in the first few years, and then it's going to get higher as the life of the policy continues.
And one thing that has to be considered is that he's saying he could get 10% on this investment. Well, that may be true. It may not be true. But also we have to remember that just because someone gets a 10% rate of return, it doesn't mean that they have an increase on the money, because you can get a 10% rate of return and still lose money.
In fact, his dad does a video on this where he explains how you can earn a positive average rate of return and still lose money. Same investment, and that video is on McPhee Insurance YouTube. If you go to McPhee Insurance on YouTube and search for rate of return, that video will show up. You can watch it. It's very fascinating. You can actually lose money while you're earning a positive average rate of return. We're not saying that's what's happening here in this YREFI investment. We're just saying it's something you should be aware of so that when you're evaluating investments like this YREFI investment, you can determine whether that's a possibility. The next question we have is, can we use IBC in today's economic climate? How does one leverage infinite banking in today's economic climate? Most of the examples where I've seen where IBC helped people become wealthy in the past is real estate. But this was when borrowing was really cheap. Today, if we borrow against our cash value, we would experience a negative IRR. That stands for internal rate of return. Basically, in the current environment, it would make sense to use IBC only if the net return of your investment after borrowing against your cash value gives at least 3 to 4%. What kind of non-shady investment opportunities like that are available?
Can IBC be effectively used in this current economic environment? Absolutely. We're doing it. We have hundreds of clients doing it. It is a concept that has a process to it. It's not whether the economy is good or the economy is poor or the economy is raging or the economy is, declining. It's a matter of how to recover the money that you spend. How do you recover the interest that you're going to lose if you don't use the infinite banking concept? So yes, it works in all kinds of environments.
In certain instances, in certain environments, under certain situations, it may be more profitable or more effective than others, but it still works because it is a process. It's not a product. It's not determined. Its success is not based on the economic environment per se. In fact, we have a book on our website. It was written by John. It's an ebook, and you can get a copy of it. If you go to McPhee Insurance, the store page, it is called, I'll pull it up right here, Understanding the Infinite Banking Concept and How It Works in Our Modern Environment. That book is excellent. It is less than $4, and you can download it right away, read it right away. It's got examples, and it's a wonderful answer to that question. Does infinite banking concept work in today's economic climate?
I suppose the question could also be asked, does the American dollar work in today's economic environment? Yes, it does. It works in a good economy. It works in a more difficult economy like we're facing today. We still use American dollars. Yes, it takes more of them to purchase goods at the store, but we still use the American dollar. It's still fungible. And so when we look at the infinite banking concept, can we still use it in this environment? Oh, absolutely. It's a tool.
Yes.
The other part of that question was it only makes sense to make an investment if it's going to be 3% more than...
If it gives at least 3 to 4% because of borrowing the cash value is what they're saying.
Sure.
And they're saying that they've only really seen it work to make people wealthy with real estate. And since real estate's higher now, which may be a direct reference to Nelson's book, where that is how he founded the infinite banking concept. He found himself owing lots of money back in the 80s when interest rates jumped. He was paying 23% all of a sudden on money that he had borrowed. And he said the infinite banking concept was born between the hours of 3 to 4 a.m. when he was on his knees praying, how do I get myself out of this mess that I have created for myself? And he says, for myself, I took responsibility. It was me that had borrowed the money. He said the answer came back about like a baseball bat across the eyes. It says, you have everything you need and you can't see it just because you're looking at things the way everybody else is looking at them. You can get money during these tough economic times from your life insurance policies at about 8%. Well, 8% is a far cry from 23%. That's almost a third of what he was paying. And that's what he did. And that's how he discovered, we could access money because of our life insurance policies, and he named it the infinite banking concept.
That 23% that Nelson was paying back in 1982 isn't a whole lot different than the 24% people are paying on credit card interest today.
24% or more percent. Yes.
That's the average 2025 credit card balance.
That is
interest.
Just unbelievable to me. Number one, I don't understand how somebody would voluntarily go into that type of debt. Maybe they're not looking ahead and realizing how expensive that interest is, but how would you wind up in that situation to begin with?
There are people that are, stuck with an emergency that they don't have any other cash flow that they can do that with. And whether it's medical or whether it's a fire or a flood or a tornado or any other type of thing that happens unexpectedly in life. And most people in America today don't have the money in reserve that they could pay for an emergency expense of $1,000. They would have to do it on some type of credit. And credit cards are just a real easy, quick way to access that money. Having a life insurance policy where you can borrow from to pay off that credit card if you have to use it quickly, and then take a loan from your policy before there's any interest accrued on that card, can save you a tremendous amount of money because most insurance companies are loaning money at around 5% right now.
That's an excellent use to be able to pay them off quickly.
This person says that they've only heard it around the real estate example. Well, infinite banking concept is infinite because when you start putting your imagination to use, you can think of all kinds of things that you can use to better your financial picture through using the infinite banking concept. So
That
it is an exercise in imagination.
What you're saying is basically addressing the last portion of this question is what kind of non-shady investment opportunities like that are available. And what you just said is you can find something.
Mm-hmm.
For example, right now, I am buying and selling used equipment. That's a good investment for me. I'm doing more than 3 to 4% on that. That might not be a good investment for somebody else that does not know about that.
It would not be a good investment for me because I have not spent the time like you have going through and looking at all the specs on the different pieces of equipment. And I noticed that when you started doing this, you started doing a lot of research first on all those different pieces of equipment that you were interested in purchasing and reselling. I haven't put the time into that. So it would be a terrible thing for me to go and make the investment that you have studied about, read about, and know that you have potential in that market.
And that's the story for you too. You probably know something about something that most people might not know. And that could be a good investment area for you. You have to find out, you have to look at the opportunity, you have to evaluate that. Just because something's a good investment for me doesn't mean it's a good investment for you, and vice versa. A good investment for you might not be a good investment for me. Can you do more than 3 to 4%? I believe you can. The next question is, DS9 episode, Jake was undercapitalized. I enjoy Star Trek DS9. The way they build up the culture and economics of the Ferengi is quite entertaining. In the episode, In the Cards, the captain's son decides to buy his dad an old baseball card to cheer him up. However, Starfleet doesn't have the money, i.e. Latinum. And so Jake is begging his Ferengi friend Nog to give it to him. I blurted out that this demand for a medium of exchange would have pushed enough of Starfleet to move back to money. You can't expect the whole of Starfleet to resist the pressure. And the way Jake begs Nog sounded a lot like when you go to a third-party lender to beg for a loan. He who has the gold makes the rules. Don't be caught without a sufficient supply of capital. Well, I have never watched Star Trek, and Star Trek fans, you're going to have to forgive me if I pronounced any of that wrong. But I do understand the basic message here that he who has the gold makes the rules. That is the golden rule, according to Nelson Nash. Of course, it would be the secondary golden rule. But that's true. It's been said that bankers are people who will lend you money if you can prove that you don't need it. And the infinite banking concept really does allow you to become your own banker, like Nelson says, because you can leverage your policy with just a signature loan. If you want the money as a loan, it's fully collateralized. You get the money. You don't have to prove that you can pay it back or prove that you don't have need of it to be able to acquire it. You can just say, I want the loan, and you get the loan. So infinite banking concept is great for financing things at a moment's notice, even if it is an old baseball card. Maybe it would even work in Star Trek.
And the reason someone can just get a signature loan is because it's based on the value of what they have paid into the insurance company and the value that is represented in that policy. So if you go to take a loan, all you have to do is say, hey, I want a loan. And they don't have to say, well, what are you borrowing it for? And you don't have to be underwritten for that loan because you were underwritten for the life insurance policy where the value is stored.
Your loan is fully collateralized. It's no risk to the insurance company. The next question we have is, why infinite banking? And it just says, anybody have the time or energy to tell me why I should get a life policy and how that is a good investment strategy? Smiley face.
Infinite banking is not an investment. Infinite banking is a concept. It's a process. You need to become educated about the process, because if you think it's a product, the product which we use in infinite banking is not going to behave like a typical investment. The infinite banking concept process is about recovering the cost of things you purchase. That's called the cost of finance. And if we can recover the cost of finance, we not only have what we purchased, whether it's an asset, whether it's an automobile, whether it's a piece of real estate, whatever it is, then we have the opportunity to have the money back that we paid for that, plus the growth that happened in the policy.
And what you're saying is that it is not an investment strategy at all.
It isn't.
Because they say, how is that a good investment strategy? So number one, it's not an investment strategy. But the reason that you should own participating whole life insurance is because you are going to get the guaranteed growth, any dividends that are paid. You're going to have the protection and the peace of mind of having a death benefit. And you're going to be able to leverage that money to finance things that you're already buying in life. And why wouldn't you want all of those things instead of just one of them? The next question we have is first Penn Mutual Policy questions. And they say, I just started my first policy with Penn Mutual. I have 2 questions for anyone more familiar with the Penn Mutual portal. How do I take out a loan? There is a form to fill out and request a loan, but it says to either physically mail or fax the form when complete. Is there another way to do this electronically in the policy portal? Additionally, I had the policy designed to put in $10,000 per year. The portal says annual payment limit $26,611.36. Does this maximum limit they list stay within the MEC limit or exceed the MEC limit? I am able to max fund their listed limit, but I don't want to MEC. Thanks for any assistance.
I'm not familiar with the Penn Mutual
portal
at all, but all the insurance companies that we represent, you can fax the form in, you can call a loan in.
Or if you're a client of McPhee Insurance, all you do is call our office and we do all the paperwork for you.
That's
right.
So
there's that.
Yeah. So in this case, this person should be approaching their agent and asking why they are not helping them do this. That's the best play. But sometimes that agent has disappeared already because they've made the sell.
That's something that is standing out to me about this question also. It is easy, the way it is structured in the insurance field, for an agent to desert the customer after they sell the policy. And the reason is that the commission, the highest amount of commission paid, will be paid right after the sale of the policy. So at that point, there's very little left to be earned out of that one sale. However, we feel a little bit differently. We feel that that is really the beginning of our relationship with the client. We are being paid, as we see it, not only to sell the policy, but also to service the policy for them. So if they need loans, we're there to help with that. If they need to change the address, we're there to help with that. If they need to change beneficiary when they get married, we're there to help with that. If their family needs to collect the death benefit on the policy, we're there to help with that. That's probably not typical. We see a lot of cases where once the agent has sold the policy, sometimes the customer can't even get a hold of them anymore. Well, I don't know if that's what's going on here, if that's why they resorted to asking their question on Reddit, but it is possible.
As far as the $26,000 maximum payment, I'm not looking at the policy that she's talking about, but in the policies that we sell, it tells us what the maximum payment can be before the policy becomes a modified endowment contract. In some of the policies we sell too, you can overfund the paid up additions rider and you could make it a modified endowment contract if you paid all of what the insurance company would allow you to. So without further looking at this policy, I couldn't give any advice, but have her read, and I believe this was a female question. If it wasn't, I apologize, but have them read the contract. It will tell them what that $26,000 is in the fine print. And if they have a question about it, call our office and send it over. We'll review the policy for them.
Yep, that's true.
Or they can always call Penn Mutual too and ask them, what is the amount I can pay without causing the policy to become a modified endowment contract, just to confirm.
That's true. And for those of you listening who aren't familiar with modified endowment contract and MEC was in the question, it's MEC. It stands for Modified Endowment Contract. And what that means is the IRS looks at how quickly you fund a life insurance policy. So they're taking 2 considerations into factor. That would be money and time. And if those don't meet what's called a 7-pay test, then they say this is not life insurance for tax purposes. It is a modified endowment contract. And it gets different taxes applied to it than it would if it were life insurance. So it's most often something you want to avoid. You don't want your policy to become a modified endowment contract if you're practicing infinite banking most of the time. And so you want to pay less than the payment limit before it becomes a modified endowment contract. The next question that we have is called Rockefeller setup. And the question is, so looking at working with a trusted expert to set up an irrevocable trust with the full-term life insurance for high cash value. My question is, I'm relatively young and my net income / cash flow is rapidly accelerating year over year. So when I choose a policy today that I can afford X premiums per month / annum for my family, what happens when my cash flow from income other than insurance, obviously, increases dramatically over the coming years and I want to pour more into the premiums to increase the cash balance and death benefit over time? I understand that the trust is irrevocable and cannot be changed. My understanding is that the insurance policies are equally unchangeable once they are set in place. I believe that some policies you would be able to pay on top of your required premium and get a benefit for that, but I would appreciate someone shedding a little bit more light on these options before I engage on this setup.
Expanding your infinite banking concept by adding more money to the pool that you're borrowing from or paying premiums in life insurance can be attained in two different ways. And yes, you can add a small amount of money to an existing policy without triggering the modified endowment contract rule of the IRS. And the only reason that you are concerned about that rule is you don't want the loans to become taxable and you don't want the dividends of the policy to become taxable. But it's still much easier not to worry about crossing the MEC line by just saying, hey, my income went up, let's buy another policy. I mean, this is what happened to us. I started my first policy with $30,000 and a few years later, I started another one for $60,000. $60,000 wouldn't fit in the $30,000 policy. If it did, it would have been a modified endowment contract. A few years later, we started another one with more money. We ended up having 8 policies on my life, 8 policies on Michelle, and we had a total of 60 policies at one time because money has to be stored someplace. And so it doesn't matter how many policies you have to practice your infinite banking with. What matters most is that you only start that next policy when it's comfortable and affordable for you to do so.
When McDonald's opens a restaurant, they become profitable at their new location, and they don't take those profits and add on a second story. Instead, they go down the street, maybe just a few blocks, and they open a second location. Why did they open a second location? Because they can be more profitable. That's what we need to be thinking about with the infinite banking concept. We don't just want to try to fit every dollar into the policy we have, but we can open a second policy. And you start with where you're at with the finances you have, and then later on, you can purchase an additional policy. Now you'll have 2 policies working for you.
The only concern about waiting to start more policies is there's things that can happen, and one of those would be adverse health consequences that prevent you from qualifying for more whole life insurance. That is a real concern, but there is also a protection that you can purchase against that, and that would be convertible term life insurance. Term life insurance is significantly less expensive for the premium dollar to the death benefit ratio. The only problem is it's temporary. However, if you buy convertible term insurance, let's say you buy a block of $5 million worth of coverage, you can get that relatively inexpensively. And then as you're ready to start more whole life insurance policies, you don't have to go through underwriting again. God forbid you were to acquire some sort of adverse health condition, you can still convert your convertible term insurance coverage to permanent whole life insurance coverage just by paying the premium required for that policy. No underwriting based on your health whatsoever. And that can be insurance to buy insurance. It's a great way to do it. It's a great way for people that can't afford enough whole life insurance to have the death benefit coverage they want for their family to supplement with convertible term insurance and have the ability to turn that into permanent insurance down the road.
And that works especially well with people that are under about 55 years of age because the term price is very competitive,
it's very affordable,
inexpensive. And once we get a little bit older, now that term becomes really too costly to really make that a consideration.
55 or less, this is your chance. All right, we're going to look at the next question. IBC question. I have had an IBC policy for 2 years. It is a small one. I put $20,000 down and pay $1,200 a month into it. I really want to get a policy for my husband. We don't have much cash flow happening yet, but with my year-end bonuses each year, I could put $10,000 into his policy a year. It would obviously have to be a pretty small policy, but I want to get it going sooner than later since he will turn 36 next month. I also want to start a policy for our newborn son when he is born this summer, but would only have $150 a month to put towards his policy. My question is, if it is worth starting a policy if it is going to be a smaller dollar amount. I know the older we get, the harder it is to get insured, so I wanted to get my husband a policy ASAP, but don't have a ton of money to capitalize it.
If I was talking to this person on the phone, I would congratulate her on getting her policy started and for having the impetus to get one started on her husband while they're still in the middle-aged, 36 age year range. You know, as far as a small policy or a large policy, she's talking about $10,000, $20,000 here. For some people, that would be a huge policy. For other people, it would be hardly anything. So how big a policy isn't as important as how it relates to what your income is. And we always go back to the 10-20-70 principle. Let's start with 10% of what we're making, and let's make sure that we're getting that into premiums of whole life insurance, whether it's on herself, whether it's on her husband. And maybe that extra $10,000 starting on her husband right now, maybe that's going to be a little bit excessive for them. And the way they can figure it out is just go to the 10-20-70 principle and figure out, where is this going to align with me? If it doesn't align with that, then maybe they buy convertible term like we talked about on that last question on her husband, so that down the road, they're going to be able to initiate that whole life policy out of that term, convertible term, especially when her premiums start going down in the next 5, 6, 7 years.
Something she says in this is that she put $20,000 down on her policy and then has been paying $1,200 a month. If we had written these policies for this couple, chances are we probably would not have done that. I'm guessing that they got what's called a 90-10 policy. You can find out about a 90-10 policy, the pros and cons of a 90-10 policy, in a video that we have on the McPhee Insurance YouTube channel. If you go to McPhee Insurance on YouTube and search 90-10, the video will show up. It's an interesting video. John cuts up Play-Doh to demonstrate how a 90-10 policy works. It is a really interesting watch and very informative. But you will see that a lot of times it's not beneficial to do that down payment like she's talking about. You can actually get better policies if you split that up and fund a policy over time. And that would make it more affordable also to insure both of them and their son as he comes along.
And especially if they're going to use these policies for the infinite banking concept, it doesn't make sense to add that term rider onto a whole life policy so you can put that $20,000 in up front. If you're understanding the infinite banking concept and understanding the process, that does not make a lot of sense.
If you're using it for infinite banking, then yes. Then what Dad's saying when he's talking about adding the term riders, that term rider is part of the 90-10 policy, and it is to keep the policy from becoming a modified endowment contract when you do that large down payment or dump in up front, as it's called. The next question we have here is IBC through Northwestern Mutual. And they say, trying to set up an IBC with Northwestern Mutual. He says he knows what an IBC is. He's calling it permanent cash value whole life. Is that IBC, or is he pulling a fast one on me?
IBC does use permanent whole life insurance, cash value whole life insurance, participating whole life insurance. So yes, having that kind of policy is good, but how is it being designed? And if he's still calling it IBC, then maybe he doesn't have all the understanding of how to design, build, and then use the policy as well.
He says he knows what an IBC is. Now, this might be the person asking the question who doesn't understand, or the agent that doesn't understand. There's a lot of questions that, we would have counter questions if we were going to get him a complete answer. But yes, cash value whole life insurance is the best product to support infinite banking concept. However, not all whole life insurance products are created equally either.
True.
So that would be an important consideration. We don't know if he's pulling a fast one on him or not. It's just too hard to say from this.
When people refer to a policy as IBC, they don't understand what IBC is. Infinite banking concept does not have to have life insurance to work. You can use your savings account. You can use your 401k and your IRA. Of course, those are going to be limited because of the tax regulations on them and the penalties that are associated with them. You can use a margin account, or you can use it as a traditional bank loan or a loan from your parents or a loan from a friend or a third-party lender. It doesn't matter what money you're using to practice infinite banking. Infinite banking is about becoming your own bank, your own banker, so that now you regulate and see how you're managing money so that you can recover the cost of what you're purchasing. That's the essence of IBC.
I remember sitting in Nelson Nash's seminar. He's obviously the author and founder of the infinite banking concept, Becoming Your Own Banker. And he would get adamant. He would say, infinite banking is a process. It is not a product.
It is.
And it's exactly what you're saying. It is not a life insurance policy. The life insurance policy that he's referring to here on Reddit, he says he knows what an IBC is. There is not an IBC. There is IBC. It's a way of thinking. It's a process.
It is. And Nelson was just as adamant about saying that it's not a sales tool for life insurance, because he understood this principle works with any money that's out and available to you. But the best product to use in infinite banking just happens to be participating whole life insurance. Will it work with other things? It will, but not as good.
Because if you do other things, you don't get guaranteed growth on your money while you're using it. So if you use a savings account, you take that money out of your savings account to make an investment or to use it like we do in IBC, then you're not getting any growth on that money. Where with the infinite banking concept and purchasing the whole life insurance policy, and then when you borrow out, well, you're still getting guaranteed growth on your money, even though you have a loan against policy.
The next question we have is, what have you been up to lately using IBC? It's been a few months, maybe even a year, since we've had much of a robust discussion on Reddit Infinite Banking about how you've actually used your policy to further your career, business, or other life goals. What's been cooking, everybody? Have you used a policy loan to start or expand a business? Tell us about it. How have policy loans impacted any real estate investment that you've got going in the high rate environment of the last couple of years? Have you taken out policy loans to do anything interesting? In December 2022, I took out a sizable policy loan to support itemized deduction lumping, and I'm gearing up to do so again this year. Of course, I paid the loan back a long time ago. Here's an article on deduction lumping for those who aren't familiar, and they put a link to deduction lumping. This question was just a month ago. What have people been doing with their infinite banking policies?
Well, fresh on my mind, I just talked to one of our clients who lives in Pasadena, California. Those were where the fires were just recently.
Very close.
He told me their house was just 3 blocks from where houses were flattened. Their house survived, but he and his family had to move out. They were out of their house quite some time. And then when they came back, they had to replace all kinds of pillows, blankets, things that absorbed the smoke. In addition to that, they had a lovely backyard and they lost 8 trees on their property. So a lot of expenses came up and you have to take care of those expenses very quickly.
Sure, replacing items, removing trees.
Staying somewhere. They couldn't live in their home. Sure. So that's, lodging, those are meals, that they would normally prepare, all those expenses that came up, clothing, don't know how quickly they had to leave. So he told me he pulled out his American Express card and he's paying 0% on that American Express card until next month.
I sense an opportunity to take policy loans next month.
Absolutely. So we were looking at his cash values. It's more than enough for him to take that money out and to pay off that credit card. And then he will turn and start paying his policy back for that loan. And he can choose an affordable monthly amount. So either what he would have been paying to the credit card company or faster or slower, depending on his cash flow. And then that money will be back there again for whatever purpose he wants to use it for. So this emergency that came up, this was not an an expected, these were not expected items for him to be purchasing. This was an emergency, and those funds are there to back up the expenses that he put on the credit card.
Which is your point from earlier about, an emergency arising and getting into credit card debt that way. I just got an email from somebody the other day who said that a tornado came through, damaged the roof on their home and their garage. And the insurance came through and assessed fair value, they felt, and they were going to be sending a settlement check. However, this tornado caused a lot of damage in the area, and the contractor's going to be very tied up and busy as soon as everybody starts getting their claim checks. So they were able to take and borrow the money from their policy to pay the contractor to get started replacing their roof before the frenzy of all the work hit. And then when their claim check came in, they were able to pay off their policy loan. And all of a sudden they have a brand new roof before, the frenzy really got going.
Yes.
So.
I was just talking to a client of ours that's been a client of ours for almost 15 years, and he was wanting me to review his policy because this policy now was sold to a different company, and this company is not paying dividends, and he wants to know, is this still a good policy for me to keep? And we reviewed it, and we showed him why it was still a good policy to keep, even though the dividends are non-existent now. And he wrote back and he said to me, this policy has been a godsend. So many times over the last 15 years, I have had to use this money to finance something that came up unexpected in my business, in my personal life, or for my family. And he said it is so easy just to tap into that money, repay it, replenish it, and have it there to use again in the future.
That's beautiful. I feel like that the growth on my life insurance policies that I have is better than what I could get in a low or a savings account. And the reason savings account seems to be the best thing to equate it to is because of access. Mm-hmm. I can access it fast out of a savings account. I couldn't out of a CD, even though I could earn more. I can access it quick out of my life insurance. I couldn't, or, by leveraging my life insurance, I couldn't out of other products. So that's nice. This one is a meme. It has two buttons on the meme. Two red buttons. One is labeled direct recognition. The other is non-direct recognition. And the man who has to make the choice is just sweating. And he's wiping his brow and it says infinite bankers. Now, this meme is funny because back around circa 2018, I would guess, this was probably, it seemed like the number one question that people had about infinite banking. Is direct recognition better or is non-direct recognition better? And although it was so popular right then, I don't know, maybe it got answered in everybody's minds. I don't know, but it doesn't really seem to have been an issue since then. Although this person is posting it from 1 month ago, so.
We still get that question every once in a while. It's someone that has probably run into an agent that tells them how important it is that their policy is indirect. They only sell indirect. Well, here's why it really doesn't matter.
And for the record, we sell both direct and non-direct recognition, and we own both direct and non-direct recognition policies.
He had a policy that was indirect recognition, which means that the insurance company doesn't dock him on his dividend if he has a policy loan. What they do, though, is they lower the dividend for everybody in that business group, that group of business. So everybody that has a policy like that client subsidizes everyone else's loan because they just lower the dividend on the whole class. Direct recognition means we're going to see if you have a policy loan out. And if you do, then we're going to reduce your dividend because we don't have all that money ourselves to be working with. You're using it, and so you can't share in all the profits. It's just real simple. And if we understand that going into it, it doesn't really matter whether it's direct or non-direct. And ultimately, if this company that you're with that's direct or non-direct gets sold out to another company, guess what? You don't know what it's going to be.
You have no dividend.
The important thing is we don't need to sweat blood and tears over direct and non-direct recognition. We need to be sweating over the guarantees. What are the guarantees? And what we're seeing recently is that the guarantees are so low in most policy contracts, and the dividends, they're projecting really high dividends. Those dividends aren't guaranteed.
They are not.
Whether they're direct or indirect, they are not guaranteed. And so if that policy gets sold, only the guarantees are going to go with it.
I cannot stress this point enough. Only look at the guaranteed values when you are deciding whether it's going to be a good policy or not. If you look at the illustration, the sales illustration, and you look at those guaranteed values and you're happy with those, that will be a good policy for you. If you're not happy with the guaranteed values, or you wouldn't be happy with the guaranteed values at any point in the illustration, that is not a good policy for you. Everything over on the non-guaranteed side of the illustration, non-guaranteed values, that's assuming dividends or an earnings rate of some kind. That is exactly what it says, non-guaranteed. So as good as those numbers look, you may never even see those numbers. In fact, you will probably never see those numbers in a lot of cases. So guaranteed values, they do not include dividends. It doesn't matter whether the dividends direct recognition or non-direct recognition. It's not included in guaranteed values, and the guaranteed values are by far the most important. Period.
We represent several different insurance companies, and oftentimes callers ask me, how are you going to choose the company that you put me with? And the answer to that is we are looking for the highest guaranteed values that you can get. And so that's what we're basing our decision on, is getting the highest guaranteed values in a policy we design for you.
And we also write with companies that pay dividends. So you will get good guaranteed values, and the potential of you getting a dividend is very good, we think. Again, not guaranteed.
I just want to step in here too and say that just because a company has high dividends doesn't mean that that's going to translate to higher cash values than a company that has a lower dividend. We've done a lot of comparative analysis and shown that a company that projects a really high dividend doesn't produce as much cash value as a company that has a lower dividend, dollar for dollar. So if someone is projecting a dividend of $10,000, it might only generate, $900 of cash value, whereas someone else might have a $4,000 dividend and it generates $6,000 of cash value. So it's the way dividends are illustrated does not mean that is the way they're going to perform. It's not money in your pocket just because the dividend is higher.
So in summary, on direct recognition versus non-direct recognition, in my opinion, it doesn't really matter that much. The next question we have is debt payoff schedule /tracker. And they say, does anyone have or know of a free schedule template or easy tracker to use? I've been making my own and wondering if there's something already created that would be easier to use with an easy way to visualize progress.
That is a quick answer to that question. Go to moneytools.net. Our son John created software. You can access it. Software for tracking your loans. You change the monthly payment, recalculates everything. Will find all kinds of loan documents in there, promissory notes, all kinds of things in case you decide to loan money to other people or to your business. You can make documentation. It's great. moneytools.net.
A lot of people ask us, how do you know if I'm loaning money to my business or to someone else? How do I know what to report on my taxes? Money Tools is the answer.
I remember you and Mom being really frustrated with the tracking solutions available for this very thing when you started Infinite Banking. And once John created the system to do it, then it's a no-brainer. So you can get that system on moneytools.net. You can even get it for free. There's a certain amount of it you can use for free. And then when you need more features of it, then it makes sense to pay for it. And you can get more features unlocked when you pay for it. Just go to moneytools.net. It's been specifically designed for the infinite banking concept. And so naturally it works really well for the infinite banking concept.
There's a lot of free calculators on that website too.
There are. Yes,
moneytools.net.
Like payment.
Oh, it's important because it's going to help you figure out. It's going to help you figure out whether it is viable and feasible for you to take a policy loan by using those calculators.
Probably for that that guy that asked the first question about the YREFI investment, he could use those calculators too. Moneytools.net is your answer, sir. Or ma'am, whoever this is answering the question. We should probably wrap it up. Do we want to do one more question or do we want to call it there?
Well, let's do one more.
All right. This question right here says, want to learn infinite banking. Okay. Hello, everyone. New to this concept and wanting to learn. Lots of confusing information online, so reaching out with a request to you all, quote, veterans to guide me on getting the basics /ABCs right. Any links/study materials that can help me get started and over time take me to master level will be much appreciated. Many thanks in advance.
I would say that a lot of people download your first book, Tom, Prescription for Wealth. We have that available as a free download, ebook or audiobook. A lot of people, that is their first introduction. That's great. We also have a lot of videos on McPhee Insurance YouTube channel. We take people's questions and we answer those. And I think a lot of people find that helpful.
So if you're a reader, go for the books. It's Prescription for Wealth. You can get that on McPheeInsurance.com. You can get it as a free ebook download, or you can buy the paperback off our website, McPheeInsurance.com or Amazon.com. You could read Becoming Your Own Banker also by R. Nelson Nash. Nelson Nash actually wrote the foreword to my dad's book, Prescription for Wealth, and said you should read that one first before reading his. It's like a nutritional supplement that you get better value out of his book if you read my dad's book first, which is pretty special, and I agree with it. It's a great book. If you like to listen, then we've got podcasts for you. That's Wealth Talks Podcast. We have lots of podcasts about the infinite banking concept, how to get started, more advanced concepts, whatever it is you're ready for, we've got podcasts for you. And if you like videos the most, then go to McPhee Insurance on YouTube, and you will find our videos about the infinite banking concept there. We present our knowledge from 2 points of view. Number one, from selling and teaching them, or selling the whole life policies for infinite banking and teaching people how infinite banking concepts work. And the second viewpoint is from owning whole life insurance and using it for infinite banking concept ourselves. And so we found what does and doesn't work over the years, and we've condensed it, and we present that in video, podcast, and book format, as well as articles that we write and have on McPheeInsurance.com and my dad's Substack, where you can find all of those things. So whether you like to read, listen, or watch, we've got it all covered for you, and you can get answers to your questions, whether you're a beginner or you need to advance.
We love to answer your questions about infinite banking because we believe that if you understand how it works, then you can make the decision for yourself about how to use it and benefit from it in your life.
Thank you for joining us for this episode of the Wealth Talks Podcast, where we went through Reddit and answered lots of questions about the infinite banking concept. If you have questions that you want us to answer about the infinite banking concept that we haven't answered so far, please put them in the comments. We read the comments on these episodes. Put it in the YouTube comments, and we'll be sure to answer your question on an upcoming episode of the Wealth Talks Podcast.
There's a lot of information on the internet about infinite banking concept. Some good, some bad. Agents that are selling life insurance can give you good or bad information. But you don't have to choose to be confused. We're going to talk about that right here next week on Wealth Talks.